Good morning. Welcome to YX Insights. Today is April 24th, Friday. It's before the market open. Not a lot has happened since our last update. We have seen a continuation of the US-Iran ceasefire, and it doesn't seem to be progressing in terms of negotiations. We're seeing lots of tweets, posts from Trump shouting quite loudly that the US is in a strong position of strength, and it seems like Iran doesn't really like it, and therefore the negotiations seem to have stalled. And I think there is a distinct possibility for both sides that they're using this ceasefire not as an olive branch, but as a way of just stalling the progress and repositioning themselves with the US potentially with blockade and intercepting the Iranian-related oil tankers, trying to put more financial pressure on Iran. But there's also the possibility of ground troop invasion if this doesn't work out and negotiations stall forever. I wouldn't rule out 100%, but it seems that the chances have decreased a little bit. But I would say that still is on the table. And Iran seems to be quite split about whether they should go more hawkish or dovish towards the US negotiations. I do think there are probably internal factions that are locking heads with each other, because you get the news headline saying Iran was willing to open the strait, and the next day it's closing the strait, and they're saying they could come to the negotiation table, but then they're really annoyed at Trump's post on Truth Social, saying the US has won and talking down on Iranian officials, etc. So there's a lot of public PR war going on as well, alongside the stalemate on the ground. And this week, as the negotiations continue to stall, we're seeing oil spiking again, resurging. So this is the Brent crude oil price. It's not the WTI, but still $105, which is quite close to the previous highs around 110. So we're definitely approaching the most tense period again in terms of the oil price expectation. And if you look at the oil curve, this is the WTI crude oil futures. So WTI trades just under 100 this morning. And if you compare that with the beginning of the ceasefire on April 8th, the front end contract is actually up 10%. And if you look even further back, so the year-end contracts still up 5% from the beginning of the ceasefire, and obviously a lot higher than beginning of March. So the oil market is not that optimistic that negotiations will resolve in the reopening of the Strait of Hormuz anytime soon, and is really starting to price a prolonged period of elevated prices. And I think if you're only trading equities, you're not looking at the other markets, it might seem that the market is really optimistic that the war will resolve soon, given how elevated the equities have been. But not all markets are agreeing with each other. So that is something to stay cautious about. And the second thing I'm looking at is the TGA balance. So I talk about this chart when I see something unusual. So mid-April, so 15th of April was the tax season deadline. And just around that date and in the week after, so in the past 2 weeks, we're seeing a sharp spike of the TGA balance. So the TGA balance is the Treasury's general account at the Fed. A higher TGA balance means there is payments flowing into the Treasury, for example, tax receipts, and that drains the bank reserves, which provide the liquidity for the US Treasury market and the stock market, for example. So what you tend to see is that there is a 10 to 20-day lag between the rise and fall of this Treasury balance versus the SP 500. So I think the clear estimate between 10 to 20 days is a bit difficult. But if we take the 10-day, the faster estimate, for example, we're using the TGA balance, the inverse of TGA balance. So a higher balance is worse for the stock market. Therefore, we're inverting the curve. And we match it with the 10-day lead against SPY, which is the dark, the navy color line here. We're seeing that a rise in TGA balance, therefore, for in the inverse measure here, corresponds to S&P 500 being weighed down 10 days later. And going into the war, and that did play a little bit of a role as well, coinciding with the stock market correction. And then recently we saw a decline in the TGA going into April 15th, mid-April, which then corresponded to a sharp rise in the equities market in the past couple of weeks. So, of course, this could be coincidental pattern matching, but let's say if this is the right observation, then we are potentially running into a bit of trouble in the next couple of weeks, because the higher the inflow of money into the TGA, therefore taking money away from the bank reserves and the market liquidity, could pressure S&P 500 down in the next couple of weeks. And if this lead is a bit longer, let's say 15 to 20 days, then we got a little bit more breathing room, maybe another 5 days or so for S&P 500 to stabilize. But still, I think going into mid-May, the market could be quite challenging based on this liquidity chart. Now, looking at how the macro elements have fared in the past month, so nearly all of April, what we're seeing is that even though oil has continued to rise, so by 20%, equities have rallied. SPY up 8%, QQ up 11%, and even small cap RWM up 11%. However, I do think there's a concentration of rallying in the big tech. If you look at the S&P 500, this is the market weighted in this index versus RSP, which is the equal weight index. There is a 3% gap, which suggests that the leadership in this rally has been a bit narrow. So it's not a broad rally as much. And at the same time, Bitcoin also rebounded. It seems to be building a short-term uptrend, showing higher highs. And gold has also risen. So it's lagged Bitcoin and the S&P, but it's rebounded from the previous lows. At the same time, I think this has helped in the sense that even oil has rallied, yields and US dollar have basically been flat in the past month. I think that stabilization in yields and the stabilization in the dollar have helped the risk-on sentiment quite a bit more. And now looking at the Max 7s, which have held the leadership in this rally, we're seeing that semis have done pretty well. So if you look at the semiconductor ETF, SOXX is up, making new highs in a straight up fashion. NVDA is below its all-time high, but up 13% in the past month, pretty good. Amazon up 21%. So an interesting observation is that Amazon now trades a bit like a semi stock because it's starting to produce its in-house chips that are better price performance. And therefore, they are actually able to accommodate its customers with the in-house chips. And there's vertical integration there, and they can potentially sell the chips to other companies as a competitor to NVIDIA and AMD. So they're not competing on the high end of the market. They're not saying that chips are the best, but on a price performance level, it is a good value. So Amazon has actually traded with SOXX for a while, I think. That could be a potential regime change for Amazon in terms of the narrative. Google up 12% as well. And then we are seeing the previous laggards like Microsoft and Meta all rebounding quite sharply, up 8-9% in the past month. The only exception has been Tesla. So Tesla had a breakout from its downtrend, but then it's fallen going into the earnings, and it has fallen a little bit more since the earnings as well. So we're going to talk about Tesla in just a moment. So looking at Tesla, this is the Tesla price reactions before this set of earnings. And as you can see, 2025 was a pretty good year. It rallied every single time almost. And then in the past 3 quarters, excluding the latest quarter, it had fallen every single time. And this time round, it fell about 3% the day after the earnings. So in the past 4 quarters, it seems that investors are first getting a little bit impatient with the robotaxi rollout, because that's been the predominant narrative for Tesla's future valuation. And they're also getting a bit more concerned this time around with the capex. So we're going to go through the financials and some of the key points, but you can always pause the video and just read through a lot of the bullet points that I've put on the slides as well, just to catch up. And I am providing a full insights article on Tesla's earnings separately as well for my subscribers. Looking at the revenue, so $22 billion this quarter, up 16% year on year. So it's the best quarter for a while on a year-over-year basis. So overall, that is a good positive direction. And if you strip out the seasonal effect, we're looking at the trading 12-month revenue. We're turning a leaf here from essentially negative growth year on year into positive growth. And of course, this is not like a massive growth story. 2% is basically flat. It's a bit like Apple a couple of years ago. So it's not really exciting for Tesla investors just looking at those financials. How do you see Tesla as a stock? Is it a car company? Yes, in the sense that 3/4 of the revenue is coming from selling its EVs, but its valuation is not really traded upon its car sales. So investors really look at Tesla through 4 pillars, and you can summarize that as the leading play in physical AI. The core pillars include AI, obviously it includes the training and inference, autonomous driving, so FSD, and then cyber cab, robotaxi. And then you look at robotics, which is Optimus. And this is a bit longer term thing. So robotics AI, it could replace human labor and become your in-house assistants as well. And Musk is very bullish on this, but it is more for 5 years out in terms of commercialization. So Tesla among the Max 7s is a standout in terms of how it links the AI software with the physical robotics and the EV. So there's a huge element of vertical integration through the supply chain that other companies don't enjoy. What this also means that Tesla is a very ambitious company with several moonshots projects chained alongside it. That means there will be a massive spend in the capex, focusing on AI chips, manufacturing, batteries, robotics. All of the projects that Tesla wants to do requires heavy capital investment. So you can pause here and just read through the major production roadmap if you like. I will just quickly go through this. So for Optimus, they're doing internal productions now, and I think they're projecting the external production and commercialization for next year. Given how often Musk has been wrong about or early about his timelines, I would even push this back for a couple of years. Musk obviously thinks this is the biggest product ever because on one side, it probably will be true down the line, because if not everyone would drive a car, but you could all have a Optimus assistance at home or even at work. You could have Optimus doing manufacturing jobs instead of human workers. So there will be a big demand for this, but it will take time as well, because robotic scaling is also harder than autos. So whatever the bottlenecks Musk had mass producing the EVs, this will be harder. But if anyone is set up to do it, you could say Tesla is the best position for that. So Cybercab production has started, but the initial ramp is quite slow. So again, you need to push out your expectation on the timeline for this. I think 2026 we're probably not seeing that much progress this year for the cybercab side. They're also producing semis, which will start soon. Looking at AI as full self-driving, so Tesla has 1.3 million users globally for FSD. The massive advantage is that so the Tesla cars on the road are collecting data all the time, and that is a faster learning curve than if you have something like Waymo, which relies on a much smaller fleet to drive around and collect data. The goal really is that full self-driving, especially when you have loads of cars that are doing full self-driving on the road, it should be safer than human drivers. And I'm actually looking forward to that scenario. And in terms of the current robotaxi, it's active in Bay Area, Dallas, Houston. I think what's let down investors is that I think in Q3 last year, Elon Musk said that 50% of households could have reached to robotaxi by the end of 2025, which obviously didn't happen. So again, this timeline is being pushed out again. And I think if we get to that mark by the end of 2026, that's probably a more realistic and actually pretty optimistic target as well. For FSD, it's been approved in Netherlands, partially approved in China. They say EU-wide approval in Q2. I actually think that's probably quite optimistic given how slow EU approvals typically are. China broader approval in Q3. Again, it's possible, but I do know that China has had this love-hate relationship about people not physically intervening and just relying heavily on the FSD features. And the Chinese authorities don't quite like that as much. So I think there will be some caveats to their approval, even if they get the FSD approval soon. And of course, the key concerns and the risk for Tesla is that all of these projects are extremely capital intensive. And indeed, the capital expenditure guidance has been raised in 2026. We'll look at the chart in a second. And for the rest of this year, we're going to expect negative free cash flows. And the execution risk is extremely high. So all the timelines Elon Musk talks about, he constantly misses them. So I will just budget for more time and patience for how Tesla will play out in terms of all these moonshots. Or in terms of monetization, the 2026 revenue uplift is not going to be material, whether from robotaxi or even Optimus, possibly in 2027. But this year, we're not really expecting a huge growth trajectory for the revenue side. And then you have the macro uncertainties in terms of high interest rates, and the tariffs are still uncertain. So the Supreme Court has pushed back on the legality of tariffs, but Trump's trying to impose tariffs through other executive powers. One thing I did spot that is that the gross margins for Tesla has increased over time quite steadily over the past 5 quarters from 16% to 21%. So that's good. That means the cost prices are stabilizing, that you're not having to cut and discount loads of your car sales. And at the same time, your cost is also stabilizing. So your margins are widening, which is a positive thing. And now going back to the CapEx. So if you look at CapEx as an item of the revenue, it doesn't seem that aggressive. We're looking at single digits, mostly low double digit CapEx spend up to this point. But if you look at CapEx as a percentage of cash flow from operations, the percentage is quite high. So Tesla is spending 60% of its cash flow from operations on capital expenditure, and this will almost double in the next year. So going from 11% of revenue to 20% of revenue by in the fourth quarter from now, and that's why we're expecting negative cash flows, free cash flows for the rest of the year. So I think the market really doesn't like, you have low monetization speed right now. So we're not seeing a immediate uplift in the revenue increases this year. At the same time, you're massively spending more capex, and we have seen the other Max 7s correcting because of exactly this reason. Looking at the valuations, so one thing I would really caveat is that you can't really value Tesla as a car company, because if you do, then you should just never trade it, right? So you shouldn't just even bother your time watching this video or even studying Tesla. So there is a lot of forward valuation pooling. So you're trying to price Tesla as a option, core option for all those amazing big TAMs it's trying to tap into, and all those revenue streams it could provide through cybercab, robotaxi, energy, as well as Optimus, so robotics. So you have to bear in mind, we're basically looking at the price of that option here. And we are looking at historically, in the past 2 years, we're trading just above the median, or in terms of price over sales, just below 1 standard deviation. So we're trading about average over the past 2 years. That's what the chart is saying. And if you look at the PE ratio, obviously it's very high, but it's kind of backed off from the 2 standard deviation. So in terms of valuation, still above what you would have paid in terms of median valuation, but it's not extremely aggressive right now. So if we can get to the median valuation, perhaps there is an entry point for Tesla. And now if we look at the technicals, we're looking at, so Tesla bottomed with the rest of the market beginning of 2023. And what I think is this overall progress is the wave 5 of a larger movement. And this is, in any wave terms, is called an ending diagonal. Why is it ending diagonal? It's because this retracing wave 4 overlaps with wave 1, and all of the waves have a 3 subwave rather than a 5 subwave for this impulsive wave 1 instead. So instead of 5 waves, getting 3 waves, and we're overlapping in terms of the pullbacks, that is likely an ending diagonal. So now we know the structure, we're trying to derive what's happening in this final 5th wave. So in an ending diagonal, if we have, again, 3-wave structure, so we could have an A, B, C here. The thing with this latest pullback, so it's retraced about 50% of this move in A from April 2025 to December 2025. And typically, so if we look back to this wave 1 to wave 3, this wave B pullback has been around 50% to 60% of this wave A. So we tapped the upper region of this target. There is still room for it to fall a little bit lower to around the 300 mark. So I'm not saying that this definitively is wave B finishing. There is room to get down to something like 300, and that will be in line with the historical norms. But let's say if we did bottom here with the rest of the market, what we could expect first is that wave C is typically the 100 to 110% extension of this wave A, and that could take us to 100 to 1000. I would just be a bit cautious where I'm marking this timeline here, because I am placing the market here more for the price level. I'm not saying we can reach this within this year straight away. Realistically speaking, if you're looking at the catalyst and the roadmap, I think we could get a re-rating in terms of the revenue growth, etc., around 2027. So I am being a bit cautious, trying to be overly optimistic about when we reach this wave C endpoint, which is almost, which is more than 200% or even 300% from where we are now. And then another thing to bear in mind for ending diagonal is that wave 3 can't be the shortest, and typically wave 5 also is longer than wave 3. So wave 5, I do expect to have a floor around 730. So that lines up well with what our wave C target. So from a technical standpoint, I think wave C can get to 750 to 1,000 for this wave 5, but try not to be too aggressive in terms of timeline. This could be talking about 2 years out. And just bear in mind with that target, we're looking at the short-term correction here. So we had a downtrend, very clear controlled downtrend from the December high, and that bottomed around 340 or just above 330. So of course, just like I said, we could tap the lower end of this volume profile or even below around 300. But in the near term, it has broken out of this downtrend and is retesting. And there is a large volume profile around here, so between 300 and 340. So I do think if we get to this volume profile region here, we could get quite strong support and investors start buying again. And that could set up a quite nice trade for wave C. And I would probably put a stop about, if we break below 300 or below this wave B low, we really have to rethink about where we are in terms of the structure. So depending on your risk tolerance. So if we have a stop below here, that's about 20%, below 340 entry target, or if you place it around 300, then it's about 10%. Okay, so now let's look at the live charts. We start with oil because I do think this chart will drive the rest of the market in the coming weeks. We had been expecting a wave B bounce when the price was trading here. So I think if oil were to top, it should probably follow this head and shoulders pattern. In any wave term is a wave 5 high, and then you have an ABC retrace. And this wave B can tap anywhere between 78% retrace of this wave A to even expanded flat up to 1.236 extension here. But my expectation is probably top out around 140, the 90% retrace for a higher target, and then we could see a wave C low again breaking this neckline. So that's how I expect the consolidation to happen. Doesn't mean we tap 140 and we head straight back down. It could consolidate for a little bit, but this consolidation here, this resurgence in oil could put pressure on the risk assets. So TLT, this is the 20+ year treasury bond. This price is inverse of the yields, so a higher price means lower yield. And TLT has consolidated here, and I think it's being pressured down because of the oil price resurgence. But to be fair, this is at a very neutral point. So at this point, I wouldn't be extremely bearish or bullish on TLT because it's actually sitting at a really comfortable midpoint. What do I mean by that? It's trading at the 200-day moving average, so it's trading at a long-term neutral point. It's trading just below the 50-day moving average, but not far below it. It's also trading around this heavy volume profile, the most concentrated volume profile. That means most investors, a lot of investors have bought or sold around here. So this is a heavily traded region, and the market is basically in agreement that despite everything that's going on, this is a fair value for bonds. So until we see a massive breakout or breakdown, we don't need to lean too heavily towards one direction or the other. One thing I do notice is that the volume has traded down in the past couple of weeks. So investors not seeing a lot of interest in either hedging or buying TLT. So this does feel like compression. With compression, there will be a breakout soon at some point. So we just have to wait for that. My near-term read, if I have to pick one side, is that with oil going higher, we're probably going to price out a bit of a near-term cut. We're going to see the yield curve shifting up a little bit in the near term, and therefore TLT could just go down and retest this trend line. But overall, it is a quite neutral picture. I'm not really leaning massively saying that it will break out to the upside or break down completely just yet. We just have to see how things evolve from here. Again, looking at S&P 500, it's basically been flat in the past week since we spoke. I think the near-term pressure is down, and it's got nothing to do with this rally being how fast it is, etc. I do think that this volume has been very small. So this rally was not widely participated. And if you compare that with the equal weight index, this rally has been quite narrow as well, led by the Max 7s, all of which I do think is due a pullback. And I think if we do get a pullback here, the natural magnet is around 660 to 670, around this 50-day moving average and 200-day moving average. That's a natural pull, and we could probably fill this gap before turning higher. But I do think this is the start of a new uptrend. It's just that we should see a pullback in the near term. QQQ. So for me, QQQ has rallied in stronger fashion than S&P 500. If you look at where we are pre-market open versus last week, we're even a bit higher, whereas the S&P 500 stalled. And interestingly, our model is more bullish on QQQ than S&P 500. And actually, there is probably a long-short strategy there. So going long on the QQQ and short S&P 500 to capture the relative play. Everything I did say about S&P 500 does stand with QQQ though. So I'm actually disagreeing with the model a little bit in the sense that I think we are due a pullback around towards the 600 mark, given the thin volume. IWM very similarly, if we get a pullback, we can retest this gap around the 50-day moving average. So I do think 250 to 256 is probably quite an attractive buying zone for the dip for the large degree wave 5. SOXX, since this breakout, it's just been one-way traffic. Our model has been very bullish on it. The only reason it hasn't used the leverage strategy is because the volatility. So we have a rule that if it's high volatility, we don't employ the leverage, because you could equally get a really sharp pullback that could amplify your loss. But overall, the model is long, and it has just been ticking higher every day. I think this is becoming a more crowded trade. Everyone's chasing this and dumping software again. And that has just been the market yo-yo. So semis versus software has been this rotation play for a lot of investors. It is now moving into the extended region of our wave 5 expectation. So this again is a ending diagonal, like what we said before. Wave 4 overlap with wave 1, and with wave 5 in the ending diagonal, it is typically longer than wave 3. And so I put a target around 424 to 470, but reality is once we get to this region, it's really hard to chase. It's getting quite extended. So I'm not chasing here, but I'm not bearish either. IGV, so IGV tapped the resistance and then pulled back as I actually largely expected. And what I really like to see is this inverse head and shoulders pattern. If we can get a bit of a deeper pullback just below the 50-day moving average, testing the low of this volume profile, and then find a rebound and breakout above this trend line, I would say that is probably signaling the correction has ended, while starting a new bull run. That's probably more of a confirmation. And if we breaks out this neckline here around 88, I think that's significantly bullish for IGV. So near term, I would want to see a bigger pullback. I think a lot of investors are piling in around this region anyway. So this is an accumulation zone. It's just about how greedy you are in trying to pick the bottom. Bitcoin. So I have been calling Bitcoin this pattern as a bottoming consolidation because we had this similar pattern before in November to January, and it's still fallen down. So you really cannot rule out the risk of downside still. And for whatever reason, there's the 4-year cycle phenomenon that people still believe in. So it could self-fulfill for greater consolidation, people trying to take off chips as it rallies. So all of that is still a psychological hurdle. we have this trend line resistance here showing higher highs. So of course, this rally is really encouraging, but I just want to see a breakout and challenging this 200-day moving average directly rather than just stalling around here. But otherwise, we could still get a pullback into this bottoming region. And we just have to see how it goes if we get that pullback. ETH, very similar, slightly weaker in relative strength, but we are in an up channel here, very similar to the November run. And we have turned down in the past week from this high on Friday, April 17th. So we just have to see how far it corrects here. Our model is not that bullish on crypto generally right now. And I'm quite interested to see if the model is right and if we can get a pullback even to the 50-day moving average or to the bottom of this channel and see how it consolidates. What could confirm the bullish bias is obviously a breakout here, challenging 200-day moving average and moving towards this wave 3 target around 3,000. Solana, pretty flat as a pancake in the past couple of months, weaker relative strength. You can really see the order of strength from Bitcoin to ETH to Solana. So this waterfall pattern in terms of market cap. And we're right around the 50-day moving average with a high volume node. I do think this is consolidation and accumulation, but we just need to see breakout before we get overly bullish. XRP, very similar. It's really not moved past the March high, so we're just bottoming consolidation here. Coinbase faced resistance around this 210 level. That was a resistance level for the March run, and that was a support level for the January 4. And after falling through here, we obviously had a massive move down to 140. So near term, I do still like an overall upward pattern, but we just haven't had the confirmation of a breakout, just like Bitcoin and ETH. So here, I'm still quite neutral for Coinbase. The New York AG recently has sued Coinbase and Gemini for its prediction markets, and saying that the prediction market is a form of illegal gambling in New York. I would say there's probably this is always the gray area for prediction markets. If you are doing predictions on sports events, political events, these did traditionally belong to the sports betting world, the bookies. It's just whether it's on blockchain or through a centralized exchange, the nature of things is the same. But when you trade against the bookies, when you place a bet against bookies, there is a casino-like sports book behind it. It's like you going to a casino, whereas the prediction market is trading versus each other is more like poker, for example. So it does fall into a more gray area. Of course, a lot of it is luck, but also how you price those things against the market. There are skill elements to it. This is a much more political debate that I personally don't really have one bias versus another, even though I do like Coinbase as a company, etc. So there is a regulatory risk on where the core ruling resides eventually. I think for poker, where you play against each other, in certain states, if you don't take a rake, then it's fine. So membership-based poker playing, where people play with each other, but you pay a membership fee to be in a private setting, that seemed okay. But if you're the casino and you're taking the rake in a state that doesn't permit gambling, that doesn't seem to be okay. And I think prediction market falls into this area. And it could be that the model becomes that you have to pay a subscription to participate in the prediction markets rather than the centralized exchange taking a cut for every trade. Robinhood, if you look at this rally here, it is just tapped the 1.38 extension of this one. So that's kind of like the minimum requirement for wave 3, but it turned down immediately. So there's a little bit of risk that actually this was an ABC rally and we are facing a deeper drawdown. So we just have to see how it retests this trend line resistance, now turn support. If we can find its way up, then this is probably a wave 3, and then we have a wave 4 correction, and then wave 5 to tap the 200-day moving average. That completes the initial 5-wave sub. But if it couldn't get support here and even gap fills here, I think the odds are that we might even see one more low here. So MSTR is basically like leverage play on Bitcoin, just under 2x leverage. Again, it's moved past this resistance zone, but it's not really that clean either. If you look at the relative rally versus wave 1, we're under 1.236 extension. So again, this could be an ABC rally rather than a wave 3 rally. So I really want to see it reach all the way to 200 to confirm this bullish bias. BMNR, just consolidating. It's going to follow ETH price, so not much to see here. SharpLink, again, consolidating, following ETH price. It trades at about 25% discount to the NAV. So it's a bit of a slow burner compared to ETH. I do think at some point, once we get into bull market, that discount will narrow to about 1. So you can capture some more upside from that. It's probably not a bad spot here. If it gap fills, I'll quite like the price around the mid $6 region. Gold, unfortunately, it turned down from the 50-day moving average. So we're looking at a retrace here. And if this was a wave 1 and wave 2 setup, we can give back about 60% of this rally. So we're really testing around 410 area to 420. So there could be a deeper pullback. Similarly for GDX, it couldn't sustainably hold above the 50 moving average, falling down. And I think we can retest the mid-80s region. Waiting for this 200-day moving average to catch up even and get support there. SLV, very similar. This rally isn't that convincing, but it looks like we're about to turn down in the near term. If this C hasn't bottomed, of course, we could get silver all the way down in the high 50s and meet with this 200-day moving average. But for now, we're just going to see how far it retraces from here. Silver miners as well, following a broader consolidation pattern. If we reach 60%, we can get all the way down to the mid-80s. Copper has been pretty resilient. Copper is a strong play for the underlying economy. It suggests industrial demand. I do think we probably will get a pullback here to retest the 50-day moving average and this high volume node before moving higher, or even this support on the resistance turn to support region here. So I do expect commodities, precious metals, and commodities generally to pull back in the near term. They have been acting more risk on, risk off with equities in the past month. So I think the markets start to converge a little bit. So if we see equities moving lower, I do think we can also see broader risk off and taking commodities lower as well. PALL, testing 200-day moving average already, so it's already corrected. Obviously, there's room to retest this volume profile here to rebuild this accumulation zone. PPLT, if this was the bottom and we get wave 2 pullback, we can retest the 170s region. Uranium has been pretty strong, so I do think we can get this moving to a new high and potentially getting to 70s despite the broader correction. BCI follows the pattern of US oil, so we are seeing a sort of potential head and shoulders patterns here. So if it could consolidate with oil here and then retest lower, that will be my expectation. So Apple has broken above this trendline resistance, and I do think we should see this rebound to reach all the way to 280, so near the all-time high, which completes the wave C of this wave B. But broadly speaking, this rally here was 3 waves, and this drawdown here was another 3 waves. So that screams an ABC corrective pattern rather than an impulsive pattern for me. And after we reach the 280 mark, I am expecting a broader retrace towards 230 again. And we have seen a lot of news around this affordable iPhone. So Tim Cook has resigned. We have a new leader. The market could be skeptical. The market will likely test the new CEO's performance after the summer in terms of its quarterly earnings calls, the product development, the timeline for the affordable phone, etc. So I would be a little bit cautious going to the second half of the year, especially in Q3. Amazon. So Amazon has been pretty strong with the semis. Like I said at the beginning, it's trades almost like a semi stock because of the in-house AI chips. Now, it is true of pullback in my books. I would like to see it retrace to 230-ish level. That will complete wave 4, and then we can get higher in wave 5 towards 300. Google has been straight up in this rally. It is approaching this resistance zone around the all-time high. The valuation has gone pretty crazy. 2 standard deviations above its 2-year median. It's very expensive. It's not a stock I like to chase around this valuation. Its growth rate hasn't really picked up, but technically it does look quite strong with momentum. It could really, it could reach 380, but to me, I think this is more of an extended run. And unfortunately, I've been more bearish on Google since Q3, Q4 last year, since valuation got out of whack. But for now, the market forgives the valuation and focuses on the technical, looking at the AI narrative. So it has room to push higher. We are not ruling that out. Meta, I do think this was quite a nice 1, 2, 3 rally. So we are probably in a new uptrend, and wave 4 could pull back. And because wave 2 is quite shallow, wave 4 could retest this 50-day moving average at the 50% retrace of wave 3. Microsoft, so this is a 1, 2, 3 rally. I think we can get a wave 4 pullback to around 400. And do think this is probably a new uptrend happening. And if we get this wave 4, it would be quite a nice inverse head and shoulders again. So this is the left shoulder, head, and right shoulder forming a neckline that's rising. NVDA is approaching the all-time high again, so there could be some resistance around this area. But overall, it does look like this wave 4 low was in at a very shallow end, and we're trading within this band. We want to see a breakout essentially for the bullish trend to continue. Palantir. So we are following a broader correction pattern, and this was lower low. So if we had a 3-wave correction, this wave 1, this wave A, wave B, and this potentially wave C. But I'm a bit more worried that actually this is probably a overlapping 5-wave move in wave A, and therefore the next rally could just be corrective as well. So, and right now we are in a broader downtrend channel. So it's not a stock I would hero buy right now. I think that we need to wait for the confirmation that it breaks out before we can buy the low. Oracle. So Oracle has stopped just shy of just around the 1.38 extension of this initial rally. So this is the natural resistance zone just below the 200-day moving average. So I really want to see this wave 1, wave 2, and then pushing into this region here for wave 3 to confirm the bullish trend before we move down. But otherwise, if we turn down here, it's quite dangerous that we had a 5-wave fall from last summer, and we are probably only seeing a corrective move up to this point, and this could be followed with a new low afterwards. So that is the bearish read, and that is actually a high probability event as well, unless we can really push through this region to invalidate the bearish outlook. APP, very clearly, this is a 5-wave down, and then we can get ABC corrective rally here, and wave C should stop just above the 20-day moving average around 540. So crowd is following IGV quite closely in terms of the daily action. We're at a point where this line here used to be the support, broke through, and we had a almost inverse head and shoulders, and now we're over here again as a resistance. So if we can't clear this resistance, then the short-term consolidation is still happening. We can't confirm the bullish run, and we can retest over here the 50-day moving average again. So breaking above this region is quite strong signal for the bullish run to continue. And also, I think we could follow IGV on the cruise as well. If we get here and IGV bottomed out, that could help us push more towards a bullish path afterwards. Cloudflare has been pretty range bound for the past year, in a slightly downward bias. It's now trading at pretty neutral level, high volume profile, 50-day and 200-day moving average. So I'm quite neutral here. I just need to see how it breaks out or breaks down afterwards. I don't think there's much of a trade going on for this ticker. Broadcom, straight up rally with the semis, new all-time high, so pretty bullish. I think we're in wave 5 now. We just need to see a retrace before for a dip buying opportunity. ASML, I think this is wave 1, 2, 3. This is wave 4 correcting, and we can get one more high here that breaks the all-time high. Since we start covering this stock, I did think that this was a bottom region and we could get a wave 1, 2 set up here, which it did. And then we had a wave 3 and 4. So now we're in wave 5, and this wave 5 is pretty relentless. It's gone around more than 200% extension of this wave 3. So here is going just parabolic. Unfortunately, I don't think it's chaseable. We need to see a correction for the dip buying opportunity. AMD, again, this is just parabolic run. So I think we're looking at a very extended wave 3, and we could get wave 4 pullback after that, and then a high in wave 5. It's probably not that tradable at those levels. Its valuation is also higher than average. So again, if we miss this trade, we shouldn't chase it. So that's it for this week. Thank you for joining us, and we'll speak again next week.